Also, to start the year, I did a little workup to the track 4, which is where these meetings come from, and they are now, once the site loads here, indexed. So you don't necessarily have to go through all the videos. You could start with, you want some risk management stuff, some market relationship, pulling the trigger. All these are titles and categorized. So if you haven't taken a look at it, you guys know that now they're indexed and there's some videos. So if I hit click trading psychology, you see the videos change at the bottom, and all the psychology videos that I've done are under here. And there's not a ton, but it kind of shortens it up and creates a nice organized way to go through it, so you don't always have to go up from the bottom up. So that's track 4, and you guys know that's how these live events, after they're recorded, where they end up. And not all of them are going to end up in one of these indexed. Let me bring this down again, because I'll get asked this question. They'll end up going at the top of the view all. So when you're in the view all mode, you're going to have all of them, and you're going to see the next date of February 6th, which is today. Got it? Now, all right, guys, sorry for that interruption, but again, people filled out the link late and they had to get approved and they're set. So getting into this session was going to be a little different until we got whacked with this volatility that kind of started last week and really kicked up yesterday afternoon, and through the overnight session early this morning. And the VIX yesterday had its biggest jump, one-day jump ever, percentage-wise, from a point. The Dow had their biggest point drop, not percentage drop, but point drop, almost 1,500 points. The futures, I don't know, what was it, 1,200 or something in the cash market. I don't think it's ever closed down 1,000 points or even up 1,000 points. But hey, price is 25,000 in the Dow, so you're going to have those now. Welcome to the new world of high equity prices. Perspective, though. Number one, we're only giving back just the 5 weeks of the rally in the year. We slowly but surely rallied a few hundred points or a couple hundred points. Yeah, we gave it back in less than a week and mostly in one session, but that's volatility. When you have an influx of volatility, it's because fear entered the market, and downside's usually the right side. Generally, you don't have upside because of volatility unless there was fear that's being unwound. What do I mean by that? Well, let's say we had downside volatility because there was a rumor that Trump was going to resign, and then they dispel it, and that's not a rumor, and so we have a relief rally. And then you have upside with volatility. So fear always creates volatility. I've said this in the trading room, and I know guys in the Edge team room have talked about this because it started to get on our radar last Wednesday with the Fed statement. I got to repeat it just to get it on the record here and to make sure guys that come into this meeting that aren't in the trading room understand it. One other thing about a little house cleaning that I got to do is, if you're not a trading room member, you could come to all these meetings. You have lifetime access to these. You're more than welcome to come. But the rule's always been, when I started the team room, that you got to maintain a trading room subscription if you're going to go into the team room every day. Dave and I didn't create the team room and put guys in there to be a slave to content. There's a ton of value I create for people and continue to give them for a lifetime. And after 3 years of doing these Tuesday meetings, there's a lot of great stuff. But I didn't create that team room and add it so that it cannibalized the trading room. And you should have a membership to both. And if you don't, I'm not going to babysit and see who does and who doesn't. That's always been the unwritten rule to it. And so, I mean, I work hard at putting good guys in there, and a lot of you guys, they're all good guys that are in there to collaborate and do all the great stuff. And if it wasn't for Dave, as you guys know, getting the link, and then for me, at Dave 1 and me 2, that room wouldn't exist. And if, you know, there'd be an empty room if I didn't put guys in it. So just keep that in mind as we go through this year as far as team room access. I want everybody that goes there to keep going there. Just remember what the rules have been. If you didn't understand them or know them, well, we do now. So getting back to why we're like this, and I got to cover this, and it's because of one word: inflation. Don't watch CNBC and even Fox Business. Bloomberg has good business channels. Tom watches a lot. They're going to tell you really the crux. They're going to have better guests on. They're not sensationalizing like CNBC will do or even Fox Business will do. Paul Tudor Jones came on, Tom mentioned, and he said inflation's going to come back with a lot of ferociousness. I don't know if that was the word. He's smarter than I am, so he probably used a better word. Inflation, just so you guys know, and I'm not moving anything on the screen right now because I'm just talking, so just sit back and listen. And maybe I'll use the webcam so it's easier for you guys to listen to me. What do you think? You guys see me? So, all right, maybe it's easier. Where does this come up? Like in the corner of the screen share? For you guys? So it'd be a little easier for you guys to listen. So it's coming. My camera is right up in the corner of a monitor, and I got all my domes. So I'm looking down, looking at price when I talk to you. So this won't come up on the recording. The screen share doesn't come up, or the webcam doesn't. The screen share does. The webcam doesn't come up on recording. And you could tell it's cold. I've got my headband on. February's in Chicago. So inflation. Why is that a economic growth killer? And by the way, you haven't heard that word in over 10, 12 years. In 2007, that was the start of the financial crisis. That's when the Fed had to hurry up and lower rates. And all the way to November of 2008, I remember because I was trading in Florida, they lowered it to zero and they introduced quantitative easing that month, that year. Kept quantitative easing for like 5 or 6 years up until 5 years ago, they tapered. Remember when they did that? I think it was March or May of 13. I don't remember the year. But Bernanke said at a Fed either statement or it was a congressional testimony that tapering was going to happen. The markets didn't like that, but they tapered it. And then the last 2 years have incrementally raised the rates. The Fed has. Only a quarter point every few meetings. And it's been digested by the markets well. I mean, we keep making higher highs over the last 2 years, and it's just new high after new high. Well, they come into this year, and Yellen steps down, a new chairperson in Powell. That's not necessarily bullish because there's uncertainty when you get a new head of anything. She makes a couple comments, I think, Friday, that valuations were too high, things that maybe Greenspan had said in the past they should keep their mouth shut. They don't. But that came on the backs of inflation being mentioned on the Fed statement Wednesday, okay? A couple things happened since then that as traders we watched. Tom mentioned one of them. A productivity number came out 7:30 on Thursday. Inside that number is unit labor costs. Again, we wouldn't watch that number or care about it for over 10 years, but it's a gauge on if there's inflation. That doubled their estimates, all right? Then on Friday, one of the components of the unemployment report is average hourly earnings. There's three components. 1 is non-farm payrolls, 2 is the unemployment rate, and 3 is average hourly earnings. In that order is their importance. When inflation isn't an issue, they don't even care about average hourly earnings. 20 years ago, I think it was 01 or 02, first month of the year, I remember average hourly earnings was a big number because we were worried about inflation. And it like downticked. It was supposed to be 0.6. It came in 0.1. It was really bullish for stocks and bearish or bullish for both because it meant inflation maybe wasn't a problem. And I'm saying this because that's another component that makes the market focused on whether inflation is indeed a fear that we should worry about or if it's just something that is flash in the pan. Average hourly earnings when every unemployment report comes out will probably be important. I say probably because I don't know for sure. 2 other numbers I want people to watch and focus on when they come out. And they usually come out in the mid-month every year. And that's every month. CPI and PPI. PPI is producer price index. CPI is consumer price index. It's what it costs, an index on what it costs producers to make things and an index on what it costs consumers to buy things. Well, if those indexes measured month over month go up and they start upticking versus estimates, that's inflationary. It's costing producers more to make things and consumers more to buy things. A good general description or definition of inflation is simply too many dollars chasing too few goods and services. Too many dollars chasing too few goods and services. It creates not just a rise in prices, but a quick rise in prices, and that's a problem. 2% year over year inflation is expected, it's normal, it's okay, it's digestible. When you start running more than that, it becomes a growth killer. And the reason is because prices become too high, so people are able to afford less, they buy less. And then the Federal Reserve has to, in order to fight inflation, do what? They have to raise rates. That's their number one mandate. It gets lost in their activities over the last 10 or 12 years, even the last 20 years. Their main mandate is to fight inflation, not spur economic growth, even though they also do that, and they've done more of that than having to fight inflation. So you adjust interest rates up to fight inflation, and the markets don't like that. The stock markets hate that. Especially, you've heard me use the phrase, they're like spoiled brats. They're so used to free candy and candy whenever they want. That's low interest rates. They're so used to that any hint of a hawkish Fed that's going to raise more than 3 times this year, and you get this. Plus, it's a perfect storm of selling because we're at highs. It's easier to go down at times when you get some fear, when you're at higher levels because there's a premium. So all that kind of came together mid to late last week and then yesterday and today. So there's pressure. The beach ball underwater metaphor I used up until middle of last week is off the table. That's how the stock markets were. Beach ball underwater, which is some downside, but it's quickly up and back through where we started. So it's really important to watch these numbers that are going to be coming out and know why the volatility has re-entered the market. It's not profit taking, although that then becomes part of it. But it started with maybe an inflationary concern. Paul Tudor Jones is one of the best traders ever. He actually hired Dr. Steenbarger, that many of you met at our workshop last July. He worked with Paul Tudor Jones for a period of time. He went on Bloomberg, as Tom mentioned earlier this morning, and said that, inflation is going to be something he feels is going to come back. And he could be talking up his positions because they do that. So either way, that's why not only are we down a lot, but we're also volatile. Bond yields. Now, this is important. And that's why I'm sharing the camera. This might have been boring if you just listened to me. But bond yields are reflective of interest rates, obviously. That's what they are. So bond prices go down, interest rates go up. I'm not going to get into why. It's just, trust me on it. Bond prices go up, the yields on that treasury go down. So typically, if a Fed is going to raise rates, bond prices go down, right? To reflect higher rates. And if they're going to lower interest rates, bond prices go up to reflect lower rates. But there's a bit of some weirdness that comes in because initially bonds got hit pretty hard to factor in a hawkish Fed to fight inflation. So yields went up, prices went down with stocks late last week. Yesterday, especially late afternoon, when fear starts to ramp up and the VIX, a measure of volatility, ramps up, you get that inverted relationship between stocks and bonds. And I mentioned that in the trading room today, this morning in the briefing that we had. And it was bond prices go up as a flight to quality, asset allocation. So when you get so much selling in stocks, where does that money go? Not in someone's mattress. It goes into treasury, something safe, especially when volatility picks up so much that you're so nervous. You're so nervous that the market is going to go to zero that you put it in bonds. And so bond prices go up in an asset allocation environment or when volatility ticks up and there's fear like there's been the last few sessions. So I think we covered that. Inflation's the reason. It's resurfaced, never been talked about for the better part of 10 years since the financial crisis. CPI, PPI numbers haven't been a worry for 10 years. Average hourly earnings, unit labor costs, some of these subcomponents, prices paid components of ISM and ISM non-manufacturing are other components to watch that are inflationary. So these are the notes you should take. CPI, PPI, unit labor costs, prices paid components of these numbers, and average hourly earnings, which is one of the components in the unemployment report every first Friday. If inflation is going to continue to be a worry and it's going to be something that strikes us, they're going to really affect and create some good movement in both markets. When they happen, bonds and stocks might move together, but we'll keep you guys aware and on that when they come out. When it's a lot of fear like we've had, it's opposite. And that's what I'm going to get into and show you some stuff, dome next to dome, and go over some other things to really kick off this meeting. But I had to do this talk to get everybody up to speed as to why we've got it and how to handle it. And as real professional traders, this is what we want. We want this market to stay this busy or this kind of price action forever. It won't, but that's what we want. All right, so let's get to the screen. Let me cut this off. I don't want you guys getting distracted by staring at me. Then you won't focus on the other screen. I have that effect. So the screen share, don't get all giddy. What do I mean by that? I don't want people to be like cheerleaders at a high school basketball game. High highs, all excited, it's busy, or just listen, this is what we want. Be objective and be calm. All right. I want you guys to understand that the style of choice in a volatile environment is this one in the bottom left. Breakouts. It's hard to buy support and sell resistance. Peter came out earlier this morning, and he's a main contributor in the team room, and he talked about ready, aim, fire approach that we've done some edge meetings on. You can't just be ready and buy it, and you get picked off. You'll be on railroad tracks all day long. You got to have, okay, I'm ready if it gets to an area I want to buy, and then your aim and fire techniques in order to qualify. But the style is breakout, meaning that's what volatility is. Breakout city. Couple other points I want to make. It's what you don't lose. You've heard this said before by me, by others. It's not how much you make, it's what you don't lose. All right? Focus on that and know what you're going to lose every time you click the mouse. You got to be a risk master, not a risk manager, a risk master. You can't manage your risk, you got to master it. You got to know everything that you're planning on doing from an exit strategy for losers. And you can play around with your winners and click to get out. But remember, market orders are for me and for most when it's really volatile, is the order type is the phrase I was looking for. But you got to manage your risk. And the only way to master and manage your risk is to know where you're getting out before you get in, and risk points and not ticks if you're an ES trader. Correlations for comfort. I'm going to show you what that means in a second. I went into the team room later yesterday and caught a couple bond trades, called a couple trades I didn't take. But if you're listening, you're like, you want to be able to say, how did he know that? Why did he say that? This morning in the trading room, I missed 05s in the bonds. How did I know that? Why did he say that? That's what you guys should be asking and following up. Correlations for comfort. We're starting a rally right now through 50. Stack the winners. Generally, you're going to have more trade. Generally, you're going to have more trades when it's volatile. If you're comfortable in a trader. If you're not, and volatility make you trade less. But there's a reason why volumes jump in volatile markets, because more people are trading it. So you're going to have more trades in more volatile markets, and you're going to be contributing to the higher volumes, generally speaking. If you have one trade and you get smashed, then you're not going to have a lot of volume because you're going to be done. If you're if you take your first trade and you get killed, you're going to be a little gun shy. But when I say stack the winners, that means you're not trying to have the giant winner and that's going to make your day. Those will come, but don't go for them every time you click the mouse. But a breakout style is the style of choice in volatile markets because they break out a lot. Okay? Because they break out a lot. Now, let's go to the charts. Chart familiar for most of you to see is the trading room, and you could see us. First, a couple things. No matter what market you trade, your P&F rotation has to go up. So if I open this chart up and I put it back on a 4 P&F, which is this guy, let it fill out a little bit, it's too noisy. It's too noisy. Too many bars, and I can only see what happened a minute ago. But if I go to a 12 P&F, which I went to this morning before we opened, you kind of get a little bit more good rotation. A little bit more flow to the rotation. We stopped here. We coiled underneath it. This is the white VWAP. We went through it, let out some green. Is it a surprise we broke out as I was talking? No. Anybody, again, breakout. Anybody that's been in this course could see that this is the consolidation that was forming. This was a couple tops. Again, these are 12 P&Fs. So 3 times through this 46 even area is probably 7 times on a 4 P&F. Let's look at it. 46 is where they broke out. If I go to a 4 P&F, I got to take it back to where it broke out of 46. Look at all these rotations. 1, 2, 3, 4, 5. And then finally it goes. This is what it looks like on a 4 P&F, but kind of noisy in here. You see the shelf building 45, 46 on a 4. And then if we go to a 12, that's what it looks like right there. Just one rotation where my cursor is, down, second rotation, third rotation, it got hot. And it went and didn't look back until, old resistance, new support. Breakout. All right? So there's a breakout coming above here. It doesn't surprise you. They fire it up to the up. And this is kind of midday. It's settled down a little bit. Even though we're still moving, it's settled down. We didn't get to, I thought, when I left the trading room, I thought we were going to go to the open, which is 0175 down in here. We didn't. Where would I change my mind? You guys know this. Where would I change my mind? Either in this bar up or this bar up. Certainly in this bar up. I wouldn't still be thinking we're going to the open when we're trading 50, 57 like we are now. So that's the key with where you think it's going to go. Let the market change its mind, and don't worry about it being your decision, your opinion. It's the market's opinion. Period. Now, this is a 12 PNF, so it's some tips on a volatile market. You got to go up on your PNF so you have something that's comfortable. I think a 24 might be good in the NASDAQ, but you got to play with it. You guys are proficient enough to how what we're trying to find for the appropriate PNF number and filter number and imbalance and everything else. So the imbalance is you don't want too many reds and greens, you don't want too few. So for a 12 PNF, I just happened to change it this morning, 987 threshold. That I kept the same, but 150 I went down to because anything more I wasn't getting any edge zones. All right. On the display, it's 500. I keep all those 500. So I always have reds and greens at 500%. But the edge zones won't come across unless they're both 987 with a min diff of 150 on this chart. All right. Breakouts, you could see it come down and stop to the tick and then rally up 3 points, which doesn't seem like a lot, but could add up, right? Certainly you don't want to take 5-point, 6-point losers. Let me recap this. If you're not willing to risk or lose 2 or 3 points in the S&Ps, throw your mouse in the garbage. Cut it off and throw it in the garbage. Spectate. It's hard to manage your risk inside 2 or 3 points. All right. If you add to losers, you are a loser and you're going to be poor soon. Paul Tudor Jones came up with that phrase, losers add to losers. Wish I came up with it. He did. So you can't add to losers. We talk about that in all markets. These markets, you'll have a winner, you'll average, and then you'll get beat up, lose everything you made, not only today, but if you were up for the year and for last year. So that's important. 53s are now support. However, they're building a case where sell stops are below it. You're going to see a lot of selling come in if they get through 52.5. Start making these predictions and these calls if you're spectating and not trading. All right? For a 12 PNF. Now, we could take the 12 PNF down to a 6 tomorrow, as early as tomorrow, depending on how the volatility goes. There's no scientific reason to take it up or down. So I don't look at the volatility and say, all right, when the VIX gets to 48, we go to a 6. Don't get into that. I'm not saying anybody is trying to do that, but sometimes our minds try to get us scientific to make us comfortable. Screw that. You don't want to get to be comfortable. You want to be uncomfortably, you want to be good and calm in a very uncomfortable situation. You kind of want to do what you try to raise your kids. I try to raise my kids not to be out of bad situations, but to be in a position to make a good decision in a bad situation. I can't keep them out of bad spots or in bad homes that kids are doing bad things. I can't keep them out of that their whole life. But I can give them the skill set to make good decisions in bad situations, make good decisions in uncomfortable situations. So when it's volatile, it's not comfortable, especially you get a little heat, you got to be calm. See the selling that's coming in through 52.5? You got to get yourself to have those opinions before you could trade them. Now, if you sold it at 53, it goes to 51. You don't take profit. You do take profit. You scratch it. You don't, but you have a plan going into the whole thing. You've seen the selling pick up through 53, comes right back. If it doesn't hold 53, 54, it's a head fake. We're going to go back up. Right there, 53, 54. So you could have taken the trade, had a little winner, scratched it, taken the loss. It was a head fake, and it is what it is. But you did see the selling come in down in here. Now, does 56 hold as resistance? Probably, but don't make too many opinions or don't create too many opinions. Just look for the structure to get formed and where a breakout might happen. Now, I'm not really trading a lot of S&Ps with the breakouts. What I'm doing is taking a look at the bond market at the same time you get these anticipated moves in the S&P. This is a 1-minute line chart of the S&P on the left and the 30-year bonds on the right. It's no coincidence that when you had this peak right here, 1121, you had this peak right here. 1122. They started going up in the ES and down in the bonds, the opposite inverted relationship I talked about at the start of the trading room and at the start of this meeting, because fears come in. The VIX is kicked up. Volatility is up. People are reallocating their funds. So when they're selling stocks, they're buying bonds, but when they're buying stocks, they're selling bonds. I thought the bonds had a chance to go from 08 to 15. I didn't think that forever. I thought that they could break out. Let me blow this chart up. Simple. You got to keep things really simple. All the times, even more simple in volatile trades. I thought that they had a breakout coming, and they did. They just didn't do it. Let me throw my lines up here. You see this high, and this one, and that one, and that one? I thought that they could get through there and they could go to 15. Well, they didn't. I didn't continue to think that now or even in here. At some point, I changed my mind after 10:30 because it wasn't happening. So what did they do? They end up taking the bottom of the consolidation. They didn't take the top. They took the bottom out right there. What would I be looking for? And I didn't trade this. But in that moment, before this happened, it doesn't look like much of a move, but it's 1, 2, 3, 4, 5 ticks. And it's 5 ticks in the bonds, which are 31.25 a tick, not 12.50. So it's a much bigger tick than most of the markets you're trading. I'm not trying to get you guys to trade this necessarily, but I do want you guys to watch it, especially when it's volatile. Now, what am I looking for around 146.0102 right here in the bonds? I see a couple swing lows that they could take out and do this. I want the S&Ps to rally. I'd like to set up a buy stop scenario in the S&P so I could jump on these 01s and push it down. Right? What time was this? This was right 15 minutes ago while I was doing this meeting. What were the S&Ps looking like? Well, if you're following the S&Ps, they were looking like going through this breakout through here and here, anticipating buyers coming in there. Not only did they come in there, not only did they break out, but that anticipated price action to the upside helped anticipate the when moment to sell the bonds. Does that make sense to people? So it's not coincidental. It's not 2020 hindsight. It's none of that. It's cause and effect. It's we're not giving you the financing on this house. Why? Because you're the only house in the neighborhood that's going for $500,000. There hadn't been a house that sold for over $420,000. You agreed to a high price. Sorry. You either pay cash or you go and tell the seller you got to come down. That's relationships. That's appraisals. That's what they do to finance homes. That's what Dan S. does his whole career. And now he's been a good bond trader because he's taken the relationship and used them, especially in an inverted environment like we're in the last day and a half. It's got to make sense to you. And if it doesn't, ask questions, but people are saying it makes sense. If you're anticipating, if you'd like to sell the bonds, a breakout to the downside, you'd like to line it up with a breakout to the upside in the stocks. Tell me where you find that on the internet. You don't. And I don't have to sell you guys anything. You've already paid for this. And yet I'm still beating and underscoring the point that you want to learn what nobody is teaching. And if you do an internet search on intermarket correlations, who's teaching it? Nobody. Why? Because it doesn't matter? No, because it does matter. Nobody uses it. If you want to learn what everybody else is learning, good. Jump into the high failure rate too, because most people fail. So in an industry where most people fail, you don't want to do what most people do, and you guys aren't. You're here. What did we do as I've been talking? We ran up again. Where did we get bullish when we couldn't get bearish in there? I said there's a breakout, sell stops, and they came, and I said, but back through 54, 53, it's not bearish. I'm not like trying to take a victory lap. I'm just trying to give you a real-time analysis of, that didn't happen. If I sold it, I'd be out. Wouldn't have lost much if I lost anything. And I'm not still stuck short with the stupid ideas it rams up in here. Now, if I was looking to sell the bonds, this is what I'd want to see, it not just going up fast in the stock, but it not only going up, but going up fast. And you get faster markets in volatile markets. That's what makes volatility volatility. Everything moves faster. So you got to move faster, and the only way to move faster is to slow things down, because that's the definition of understanding. You're not going to just wake up and get faster. You got to understand how you slow things down to move faster. I wouldn't want to sell the bonds on this move up, though. Why? Because the SOBs are already made lows here. I'd want to sell them if they walked up. I mean, I wasn't watching it, but I'd want to sell the bonds maybe at the high of these swing highs, but not here, because I feel like I might be in the hole and there's no breakout coming. But they walk up a few ticks, take a shot selling 30, 31s, and if you get a continuation to the upside in the S&Ps, you got a little head start. If you don't, you got a little head start to get out. So let's bring this back down. They, in real time, they jam them up, and then they just chop lazily sideways. So this sucks. It doesn't have a next leg up. But if you sold 30, 31s in the bonds, you don't get killed. Now I'm going to bring a dome over. These are both live domes, and I only got them set for one lots. How do you know that they're live? This is how you have to know this like the back of your hand. It's got to be just obvious to you. If this was a sim, then I couldn't change the numbers on there. See this 291 here? When I clicked a bid, it changed to 292, didn't it? Well, now it's 290. See, it's 292. Watch when I cancel it, 291. Let's go down where it probably won't change. See this 124? Oh, it's not 122. I click down there. 122, 123, 122, 123, 125, 124. Now, why am I saying that or doing that? Because if I wanted to buy the S&P or the bonds, and I don't, I think this is no man's land. It's in between. Well, let me show you what it's in between. It's in between. It's really slowed down. It's not in between anything. But to me, it's like chopping between 28, the bottom, and 31s, the top. So there's nothing really going on. I feel like I'm in the hole. If I sell it here and I'm wrong, this could happen. So I'd be more inclined to buy it. And now this opportunity came and went as I'm talking. 28, 29. I don't want to buy it unless something slaps me in the face to buy it. If I'm looking to buy it, ready moment, all right? If I'm thinking we're going to go up, my aim and fire comes from this guy right here, dome next to dome. And I start to see it sell off, maybe I could buy the 29s and have it turn. Now this market isn't moving fast enough. Not that it's not moving fast enough, but it's in this midday chop, right? And there's no identifiable breakout to the downside I could see in the S&P. Now let me bring over another dome. The VIX. I can't put orders in the VIX, but this is just an ETF, essentially, of the VIX. No matter what symbol you use for a VIX, they're all going to move the same. So this market jumps like that, we should break. This is opposite the S&Ps, therefore the same as the bonds, okay? What I want you guys to get good at doing is you need to see this sell-off and this rally, and these 28s should stay bid, and they should start getting in the 29s. See when you could get a feel of that happening. Okay? What should happen right now? They should not go 28 offer. They should go 29 bid. See how they're trading 29s now? They should go bid. And now if the S&Ps continue to go down and the VIX goes up, they should go 29 bid for good size. They're trading the 29s. She's close to going bid, but they need more help. What's the help they need? More downside in the S&P, more upside in that VIX. They're not getting it, so they hit the 28s. You see how they hit the 28s, took them offer? The 28s now, to me, as I'm watching this, become the pivotal price, meaning that the bonds are showing a little bit of weakness because they're not going up, and they should. Now, all bets are off if they keep stepping on the S&P and rallying the VIX. They will go 29 bid, 30 trade, 31 trade. But right now, the bonds are showing a little weakness. You see how they hit the 28s and took them offered? Now, if they pop this S&P and hit this VIX, they're going to hit the 27s and offer it. But if they rally the VIX and hit the S&P, what do they do to the 28s? They went up, correct? They go 28 bid when they hit this, and they go 28 bid when they hit the S&Ps, and they go 28 offer when they rally the S&Ps. This isn't a tradable moment, but this is an exercise to understand the correlations. They work a lot better when they're breakouts, when they're moving faster. Even though they're moving fast now, not as fast as they were moving yesterday, late afternoon, and early this morning. But in a moment, you want to buy it because you got support in the bonds. You're looking for the correlation to do what it's supposed to do. So if I was long 28s, I'd try to scratch them on that pop. I wouldn't want to be long 28s. You see how the VIX broke and they rallied? 28s went from bid to offer, didn't they? What did they do to the 27s? They're starting to trade them. They're starting to hit them. 27, 28's the bid offer. This goes back to the quoting everybody should be able to do. And someone was joking about in the team room, could I quote these? I could quote any market. I would just quote them wider, like yesterday. You quote the S&P's 5-handle wide the way it was moving yesterday. You don't quote it one tick wide. But you got to understand the difference between 28 bid and 28 offer in order to expand upon that. S&Ps go down and they go bid, bid, offer. 28 bid, 29 bid, 29 offer. So now they're more apt to go up. They're more eager to go up and say, okay, all right. Now you really get a push lower. They could take out the 30s, the price of 30. Just get used to what should happen and does it. The VIX goes down. That's bearish for this guy right here and bullish for this guy. Sometimes there's a lead lag between the VIX and the ES, but it's opposite. Is they go up, they go down. Remember the point that I made in that slide at the beginning of this meeting? Correlations for comfort. That's kind of what I'm talking about. Let's say you're in a position. See how the 30s go bid when they hit the 50s? When they went through and they went down from 53 to 50 to 49, they went 29, 30. Let's say you're in a position. What do you want to happen if you're long the bonds? You want the stocks to go down, right? And your VIX to rally. If they're doing that, then you could be more comfortable. You're seeing what you should see. And your predictive skills are now skills and not guesses. And there's a difference. This is where you got to look at the dome, but reference your charts. And I got everything pulled on each other, so I'm not even looking at the charts on the ES. But over here, I've got the bonds. So I could see that the bonds might have some premium to go up. But they're like not really showing anything. Like the top of this range is 09. What is this, a 6 PNF? Something wrong. Oh, there it is. That makes sense. It didn't look right. They had some resistance at 12, at 13. They never got up to. I don't like this 6 PNF right now. It's too clunky. There. You see the consolidation that they took out? Let me show you guys this. Breakout. You see it on a footprint. I showed it to you on the line chart. You see it on the footprint for the bonds. What have the bonds done? They were showing weakness until the S&Ps didn't rally, and they couldn't rally. And then remember that moment it went 28, 29? And they showed some strength. Now, this isn't a big move, but there's not big moves going on in the other markets. But they're head starts. Get used to seeing this, and you could use the correlations between the Bund and the DAX, the Bund and the Euro stocks. Those are European equity and treasury futures. out of Eurex. Make sure the correlations are inverted. They haven't been like this in a while. But when you get this influx of volatility, correlations, especially the asset allocation one, stocks and bonds will. I don't want you guys to trade this tick for tick. I want you to study it tick for tick. There's no opportunity for me to buy 28, 29s and have it go. Might make a tick or two, scratch it. But if I'm looking to buy for another reason, S&Ps are giving me upside. I'd be more comfortable. But what do I want to see the S&Ps do? Hold on, I got to pull this aside. I want to see the S&Ps. Finally did break out. I want to see the S&Ps make sure they stay below 50, 51. I got to get them down. I mean, here, while we were talking about that, what should the S&Ps do? They should have broke out below there, and they did. That's what got the bonds to go 28, really 29, 30, and 31. I should do that the other way around. 28, 29, 30, 31. Any questions? Now I'm going to wrap this up. My throat's killing me, and I wanted to give you guys a sense of an update of why we're volatile. And one last thing that this is important, and I did a survey. I wouldn't necessarily blame your platform first or your broker unless you're an IT guy and you know the memory and your speed, your processor are really good, your internet connection's great. Then blame your data provider and your broker. But a lot of times it's your computer and your internet connection. But you guys were in the room today. I didn't slow up, didn't lock up, didn't freeze up, and I've got more charts open than most people with the screen share, with GoToWebinar in the trading room. Just like that, Barbara, just on another screen where I'll have one screen with just dome after dome after dome after dome after dome after dome. I would, Barbara, but I don't know them. I'll find out for you. Ask me for a layout and I'll send it to you because I don't know. I don't want to walk through the settings of it, how to get the colors and everything. Right click, trading preferences, and play with the settings. So if you go here, oh wait, you guys aren't looking at that screen. 1 second. If you take your dome up and you go into this area and you right click and go to trading preferences, this screen will pop up and you play with them in there. Hey, so look at this. Upside, there's a breakout coming above this edge zone. They've been using it as resistance, 51, 51.5. The downside is 46 sell stops. So if you're still like long 28, 29 in the bonds, you're going to get them to pop above even if they slow them below 45, 42. So don't necessarily blame your platform. You can, and you can blame your broker, but make sure your internet connection and your memory and everything is up to snuff. And if it is, say, hey, go to them with facts and say, hey, I got this kind of connection, this kind of speed I'm running, I tested, and I got this memory and this processor. What do I need to do? Go to NASA and trade? Breakout is the style. You're a risk master. You're correlating markets to find good ideas and good opinions. I'm not trying to rework anyone's strategy, just giving them ideas for qualifying moments. I was going to kick off this year focusing on review, and we will get to that because if you're not reviewing and just previewing, you're not going to excel. but you have to have a routine. It's hard to review. It really is. But we'll go through that in the weeks ahead. Next week, we're going to have a special guest, Merritt Black from SMB Capital. He runs their futures division, or a big prop firm out of New York, similar to our firm that I came from, only they used to only trade stocks. Now they do futures. He's a big profile guy, and but he looks at it in a very simplistic way, which I like. Hey, look at this buying coming in. They're starting to get above 50, right? 50, 51. What do you think the bonds? Oh, shoot. I couldn't see it. Bonds just went 31 trade. They hit the 30s and went offer. Now, if they keep the S&Ps rallying, look at this footprint, then they'll hit the 30s, offer them, and hit the 29s and offer them. If you don't know the vernacular of 30 bid, 30 offer, 29 trade, that's where quoting is going to help you out. It's midday, so I just wanted to do that exercise to give you a sense of what to watch, and so you're not surprised the bonds went up a few ticks because the S&Ps went down a few points. Now, if there's another leg up to 57.60, they'll hit the 29s and 28s. That's a 30-year bond. There's other things you get better at. You can look at the 10-year note and how they're hitting that bid or lifting their offer to help you with a bond idea. 30s should go bid. They did. 31s, I was going to say, should go bid. They did because we sold off from 55 to 47. Listen long up down bar. It's bearish and their sell stops below 45. All right, guys. I hope this helped. I'm going to stop the recording for those watching it in the future.